Hello friends. Last week in my video, I told you that the US dollar could impact global market sentiments, particularly emerging markets. And there you are. What you are seeing is on your screen the market roundup, which tells you that the Dixie or the US dollar index rose 1.03 basis points. And that had a depressive effect on bullion and you also saw natural gas prices come down 7%, whereas crude oil rose marginally. I've been telling you there are divergent trends between oil and gas, and this is the third week you're seeing my hypothesis come true. The rally was led by the broader based Nifty 50, whereas the Bank Nifty came under pressure mainly because the dollar impacts banking more than any other sector, being inflationary because landed price of imported goods and services become higher. The Indian 10-year benchmark bond yields went up. As you can see, it crossed above 7%. That means bond prices fell, and that created a mark-to-market pressure on banking stocks. That is another reason why the Bank Nifty underperformed. The NSE gained a little over 2% in market capitalization. That tells you that the rally was somewhat broader based, as you can see from the Nifty, which is a broader index compared to the Bank Nifty, which rose. Where the overseas markets are concerned, it was the Dow Jones Industrial Average which fell, whereas the Nasdaq, which is a technology-heavy index, rose. S&P 500 also rose 1/3 of a percentage point. So overall, the overseas markets gave us tailwinds. Coming now to the in-house indicators, what we are seeing is the MWPL came down, which is a routine phenomena after expiry, but the fall is actually lower than what you would have seen last week. At 23.63%, the fall post expiry is higher than 22.65 in the April series. So risk appetite is appearing to be higher. Coming now to the turnover indices and stock futures turnover, both have risen. As a matter of fact, the stock futures turnover is almost at the highest of the 20-week period. Part of the reason is expiry, when traders tend to square up their open positions in the expiring month and roll those positions over to the next month. So turnover basically is logged twice. So discounting the fact that expiry could have also resulted in a turnover spike, the turnover being almost at the high point of the 20-week period, does tell you that one marshmallow participation was higher. Coming now to the advanced decline ratio. Remember, this is a weekly chart and the ratio is the average of the 5 trading sessions of the week. Now, the Nifty gained 1.63% as shown by the red line, and the advanced decline ratio moved up above 1 after sliding for 3 consecutive weeks prior. It's now above 1 at 1.07. That means for every 100 falling shares, there were 107 rising shares. A small indication of improvement in the one marshmallow trading sentiment. So turnover was higher, MWPL was higher, and now the advanced decline ratio is higher. So the bulls do seem to have a slightly upper hand. Now for the prompt futures basis. Basis is nothing but the futures premium or discount to the spot. Here, both the indices are logging positive basis. Do remember it's the beginning of the June derivative cycle, and traders have 1 full month ahead of them to trade, and therefore they are willing to pay a higher premium. So the basis is higher, but it's not as high as we've seen it before, after expiry just a couple of months ago. So that basically tells you that 2 marshmallow traders are not paying a very stiff premium. So far, 1 marshmallow traders have been showing signs of optimism. Coming now to the impetus, what you are seeing is a continued divergence in the impetus of the Nifty and the Bank Nifty. The Nifty rose last week, impetus was also higher, which is indicated by a blue line, and the Bank Nifty rose last week, but the impetus was down. So relatively speaking, the Bank Nifty appears to have lagged the Nifty 50. The momentum in the Bank Nifty was poorer. Now, many a times in my Live Mint articles, I've mentioned that the market is like a bicycle and both the indices are like the wheels. If there was a divergence between the front and rear wheel of a bicycle, one moves forward, the other moves backward, the bicycle can't really move in one direction, it'll fall. So this divergence is not good. We need to wait and watch and see whether both the indices are going in the same direction, in the same magnitude, and with the impetus readings going in the same direction. So far, there seems to be some caution on the Bank Nifty. Coming now to our second in-house exclusive indicator, the LWTD, what you are seeing is the blue line indicated by the Nifty percentage gain loss has jumped above zero, but the LWTD remains below zero and sideways, which tells me that fresh buying momentum on advances may be a little sluggish as compared to what we actually need to trigger a very powerful bull market. So it could be a somewhat relatively slower upthrust. Friends, I now come to the bond market, and the weekly chart of the Indian 10-year benchmark bond yield shows a slight rise in the 10-year benchmark bond yields, which means bond prices have come down. But don't read too much into it. This is coming after a protracted 9 weeks of continuous declines in the yields. So some amount of a technical pullback is expected. Also note, in the first week of June 2023, the RBI's Monetary Policy Committee is meeting to contemplate the next move on the Indian interest rates. So ahead of that, there might be a little bit of volatility in the bond yields. Friends, I now come to the Bank Nifty, which gained 0.11% by rallying on 3 out of 5 trading sessions. As you can see on the daily chart on your screen, price remains above its monthly moving average, which means the short-term outlook is positive. The 44,152 level remains as a hurdle. It remains inviolate, and we need to break out above this and close above this on a continuous closing basis to indicate a fresh up move. Moving now to the weekly chart, what you are seeing is a hammer, which is logged by the last weekly candle. A hammer is made when the price, a bullish hammer is made when the price attempts to go up, the bears push it down, but bulls manage to push the price back towards the opening level at the end of this week in the case of a weekly chart. That tells you that there was struggle during the week, but the bulls have prevailed for now. Now, this is something that indicates a slight degree of caution. It doesn't necessarily mean bearishness or bullishness. What it means is that follow-up action will be even more critical. Remember, I've told you in my previous videos that overhead supply will basically impact sentiments, because as and when any security approaches the previous swing high, there are nervous sellers who've bought at higher levels waiting to exit. So this is a part and parcel of that overhead supply consideration. We need to see whether the Bank Nifty stays above the 44,152 level comfortably or not. Price is above the 25-week exponential moving average, which means the medium-term outlook is bullish for now. Friends, in the week before last, this index was number 4 on the most volatile counters list that we maintain in-house based on statistical beta. Last week, it fell 11 notches to number 15. Now, that's a big fall. And this means the volatility on the Bank Nifty fell. which is a welcome thing for retail traders because lower volatility is something they can handle better. Last week, I advocated a possible range between 45,275 on the upside and 42,650 on the downside, which held perfectly well. In the coming week, I expect a range between 45,300 on the upside and 42,750 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 1.63% last week. And it gained on 4 out of 5 trading sessions, which is slightly better than the Bank Nifty's outlook. The 18,115 level, which I've been telling you is a good short-term support to watch out for, held. The price is above its month-long moving average, which tells me that the short-term outlook has still remained optimistic. And the 18,351 level indicated by a dotted red line has been overcome on a closing basis. The 18,604 level remains the next hurdle to watch out for. Should we close above that sustainably, I think the bulls would have tightened their grips on the market. The bulls remain dominant, but they would have tightened their grip even further in the coming week. Now looking at the weekly chart, it's a far cleaner, more convincing chart as compared to the Bank Nifty. There is a bullish engulfing pattern on the candle chart. That engulfing pattern is made when the last candle dominates and engulfs or completely covers the previous candle's body, which typically is of the opposite direction and color, which means if the last candle is bullish, the prior candle has to be bearish. So this is a bullish engulfing pattern. Price is above its 25-week exponential moving average, which tells me that the medium-term outlook is positive as of now. Friends, in the week before last, this index was number 22 on the most volatile list as per statistical beta readings. Last week, it rose 6 notches to close at number 16. That tells you that volatility on the Nifty 50 has risen. That provides a certain amount of challenge to a day trader. Last week, I advocated a range between 18,625 on the upside and 17,750 on the downside, which held. In the coming week, I anticipate a range between 18,925 on the upside and 18,100 on the downside. Friends, I now come to the last bit of statistical data, wherein we map the retail risk appetite based on the turnover contributed by the 4 segments of the market. Index and stock futures, which represent a high risk, and index and stock options, which represent slightly lower risk. Now, the turnover contribution jumped in stock futures and followed by index futures. Not really surprising. Do remember this was the expiry week. So rollovers result in dual turnover, squaring up in the expiring month and rolling over to the new month. So you will see that every 4 weeks there is a spike in the turnover in the futures segment contribution. That's the expiry part. But even if you were to discount the expiry rollover related turnover, risk appetite as given by the participation levels seem to have gone up. The fact that options turnover, especially index options turnover, has fallen sharply, it tells me that this lowest risk instrument saw the lowest contribution, which means traders were willing to bet their money on higher risk products. That means risk appetite is higher. Now, if the price is to stay buoyant or stay firm, I think bulls would have kind of consolidated their grip on the market. Now, friends, I share my thoughts on what I will do in the coming week. The last 2 weeks, I have talked to you about public sector units, especially public sector banks, interest rates, cyclical stocks, energy divergence, etc. And all that seem to have worked pretty well. Now, In the coming week, I will focus on technology stocks to trade in the direction that the snapcoat window suggests. I'm not going there with a firm bullish or bearish bias, but I think participation levels in the technology space will go up thanks to the Nasdaq rallying for the second and third week in a row. And I will also focus on cyclicals, particularly metal stocks, as well as some amount of trading in public sector banks. Now, this time around also, as last week, I would favor a slightly higher risk approach in futures rather than theta decay via the options route. In the commodity space, I would go with my bet that oil and gas may continue to have divergent trends, which means one could be going up and the other could be going down. The OPEC is meeting on 4th of June, and so is the Monetary Policy Committee meeting somewhat later. So volatility is likely to go up in commodities, especially interest rate sensitives like gold, silver, crude, etc. I will attempt to seek short opportunities in energy, both crude and natural gas, but at appropriate levels as per the screen reading and tick list signals which are prevalent on that particular day and at that particular time. Friends, I now come to the most popular segment of the market for statistically minded traders, wherein I give you 5 stocks that gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks that lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. This is for scalpers. List is valid only for Monday. Tuesday through Friday, I update this list on my Telegram channel. Do remember, this is just the name of the counters which are high and low beta or high and low volatility. Direction will be decided by the market, so you take a call as and when the market starts trading. So, beta gainers list is led by Crompton, followed by Deepak Nitride, TVS Motor, Page Industries and ITC. Beta losers list is led by Hindalco, SBI Cards, Polycab, Glenmark and Intellect Systems. Friends, before I draw this video to a close, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. I'm always eager to hear your feedback in the comments segment about how my videos are helping you become a better trader. Also, help me reach out to fellow like-minded traders by sharing my videos with your family and friends. And I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bambwani signing off for now. Have a very profitable week ahead. Bye-bye.